All right. It's almost 11, so I am gonna go ahead and get started, since it is almost Christmas, and then we are running this very last minute tax saving shop. And I apologize, for lack of heads up before we decided to go live on the 23rd. It's just been a very busy year, with the new tax law that just passed in July, and then a lot of year-end planning that we had to do with our clients. But I did want to reserve some time, today before our office close in the next 3 days to, do this presentation and then, deliver some value to people who are not able to reserve a spot, for last minute year and planning. At least we get, those valuable information out to everyone. And then, so you're not gonna be, left behind. So, good morning, everyone. So my name is Shani Liu. I am a licensed U.S. CPA and also a certified tax coach. I appreciate you trusting me with a little bit of your time today. Before we begin, just want to make sure everybody can hear me clearly. If the audio is okay, please type yes in the chat. All right. Looks like everything's working fine. Thank you. So I will try to speak slowly and directly. If at any point I am not clear or you cannot see my slides, please let me know in the chat and I will go back and elaborate. So today's goal is very specific. I want to, at very high level, review 10 powerful tax actions that you can still employ and implement before December 31st, 2025, and to help you decide which, if any, will fit your situation. So just a brief reminder, this session is intended to be educational. This is not a tailored, personalized advice. Tax outcome vary from individual to individual. So please speak with your own CPA before you decide to go ahead and act on any of the advice today. So here's the plan for the next 30 minutes. Here's the plan for the next 30 minutes. First, just a quick show of hand so I understand where everybody's starting. So please choose the option that best describe you. Number A, you have not done any 2025 tax planning. And then option 2, you have taken a few steps. Number 3, you're essentially CPA in disguise. All right, I see it's a very healthy mix that we have here today. Thank you. That helps me know how much detail to provide. So today's meeting agenda, really just on a high level. First, we're going to go over the 10 money moves, right? And then shortly after that, I will do a short numerical demonstration of how these moves can work together and save you some scary looking tax money at year end. And then toward the end, I will leave maybe 5 to 10 minutes, depending on how many people are still here, for your questions. And finally, and most importantly, you don't need to worry about, scribble frantically and take notes because we will be sending out, all these slides and a recording of today's presentation, as well as a checklist, so you can make sure that everything we talk about today, that you have it for your reference, and then you can check to see if you want to talk to your advisor or you want to ask the team for more clarification and then get some actions in place so you can see some, tangible tax saving next year. So let's dive right into it. So if your first move, right, first powerful move, prepay your expense and delay billing. Again, this is really for business that's reporting on cash basis. Now, what does that mean? That means that you recognize income when you see cash deposited in your bank statement. So if you are on a accrual basis, And this applies to business who have to issue customer invoice or they have inventory. So their income doesn't necessarily tie with their cash deposit, right? It's they recognize revenue when the expense is incurred. For cash basis business, and I think that's majority of the small business in the US, timing matters, right? So example, if you mail out a rent check today for 36,000, so you're prepaying your next year rent ahead of time, then would your landlord receive the check, let's say in January, and then they don't cash it until January, you actually get to deduct the 36,000 in 2025 while your landlord picks up the rent income in 2026. Conversely, if you wait until January 2nd to send out like your customer invoice, that move can shift the income or defer the income into 2026. Small adjustment like this can shift taxable income by tens and thousands of dollars. Move number two, buy and place equipment in service. So in July, the big, beautiful tax bill passed. And thanks to the new bill, it brought back the 100% bonus depreciation. So under the 100% bonus depreciation and Section 179, equipment used in business may be deducted in the year it's placed in service, as long as the business use is more than 50%. So I'm giving an example here where, let's say if you have a service-based business and you want to buy an iPhone, right? Or you want to buy a Mac computer before year end, then you can buy that equipment before December 31st, as long as you take it out of the box, you used it for your business, and then you can deduct that cost 100%, right? If you want to be on the more conservative side, right, you could upgrade your copier, your computers, right? Let's say you buy another photocopy for yourself for like $5,000, then that's also deductible. And the move number three is solo 401k power stack. So if you are a self-employed business owner, you are both the employee and employer. So you have two contribution links. Employee deferral for 2025 is up to 23,500 if you're under the age 50. So please check with your payroll company how much 401k contribution you've already made as an employee. You will be surprised. Like I've talked to a lot of my year-end tax planning clients, and a lot of them have not maxed it out. So we are still trying to help them, max out their employee limit before December 31st. We're, trying to, because the deadline is December 31st. If you miss that window, then that's gone, right? And then on the employer contribution side, if you're doing the solo 401k, you could contribute up to 25% of your contribution. Combined, a sole owner can probably put away $60,000. So that is pretty powerful, right? This contribution, what does that do? It can lower your taxable income immediately. And anything that you have inside your solo 401k, grow tax deferred. Heavy vehicle deduction. So I think a lot of you know, when you talk to your CPA, this comes up pretty often, right? It's year end and you're running out of time. So I think a very common suggestion is, if you are planning to buy a heavy vehicle, and that's vehicle with a gross vehicle weight rating above 6,000 pounds, they are treated as equipment. So if you purchase like a $80,000 pickup truck and use it exclusively for your business in 2025, even if you drive it for a single mile and then you document it before midnight on December 31st, the entire 80,000 is deductible in 2025. And it doesn't even matter if you finance the car, right? So your cash outlay could be $10,000 for down pay. The rest is on auto loan, but then you get the 80,000 deduction in the year that it's placed in service. And then this year, again, it's 100% bonus depreciation is back. Then you're eligible to write that off 100%. Oops, did I skip one? Oh yeah, and number five, qualified improvement property. Now, what does that mean? Think your kitchen remodeling, right? Or office remodeling. Like one of my client is doing extensive office remodel. So anything that you are doing interior, it's non-structural improvement to a commercial space. It could be painting, it could be the drywall, it could be change of lighting, right? They qualify for immediate expensing instead of being depreciated over 39 years, because these are considered qualified improvements, so they're depreciable over 15 years. And under the bonus depreciation, you could write that off immediately. So let's say, think about a $120,000 office remodel that got completed on December 29th, right? That is fully deductible in 2025. Move number six, crypto tax harvesting. This is fairly new because IRS, and I don't know if everybody knows about this, but IRS classifies cryptocurrency as property. So this is not treated like your typical stock investment, right? So if it's treated as a property, then the famous wash sale rule does not apply. What wash sale rule, loss rule means is if you sell a stock and buy back the same stock within 30 days, any loss that you've incurred on selling that stock does not get recognized, is not allowed to be recognized, right? But because this is cryptocurrency we're talking about, then that rule actually does not apply. So what does that mean in practice? So let's say if your income is low this year and then you want to cash out or bank some profit from your crypto investment, and crypto had a pretty wild year this year, right? You can't realize the gain, right? Let's say if you want to cash out, your crypto and sell it for $40,000 capital gain, you pay tax at the current lower rate, and then you can buy it immediately, buy it back if you still want to hold it for the long term, to reset the basis. So next year it's going to be at a higher basis, right? So you pay tax when in the year where your tax rate is lower, and then you still keep the same investment at higher cost basis. So in the future, if you want to sell it again, right? Let's say next year your income is going to be higher, but then you wouldn't have to worry about paying a huge capital gain because you already recognize some of that, when tax rate was lower. Let's say if you hold a cryptocurrency, if it's the opposite, right? Let's say if you hold a currency, sorry, not currency, crypto asset at a loss, and you want to sell and realize the sale, realize the loss, and repurchase the same day to keep again the same portfolio, you can, because the crypto losses can be used to offset other capital gains, right? So let's say if you have capital gain from regular stock sales, you could, consider selling your crypto investment and then offset your other capital loss. So this is called like loss harvesting. So it works pretty much the same for both crypto and stock. Difference being the wash sale rule does not apply with crypto. So meaning like you can still keep the same ETF, the same portfolio, right? And then just get adjustment in your basis and get a nice offset by harvesting the loss. Number seven is a very common strategy for business owners. Again, I employ this strategy myself. This is, hire your own kids, hire your own children. So children under the age 18, and then the IRS court case, I think the youngest age is age 7. You can hire them if they're doing bona fide work for your business. They can be paid a wage, right? So the key elements here are, some clients, I think they, misunderstood when we say, oh, hire your kids. And then they're like, oh, that's great. I can pay my kids and then we can use the money in their bank account and pay for their after school activities. And then I can contribute into the Roth. This is all awesome, right? But then the kids is actually not doing anything. So I think the first and foremost thing is that you really have a legitimate business and then you are hiring your kids to do bona fide task, meaning tasks that's appropriate for their age. Like you cannot be telling me that you're getting your 7-year-old boy to do vibe coding, even though, some of the kids are pretty advanced, but then that's just not very typical or appropriate for age, for kids their age, right? So in my own example, I hire my own 8-year-old to work for my business, and she help out with my social media. She's very good at typing, right? So I will pay her like a market rate for the task that I asked her to do. So sometimes, she would appear in my social media posts, right? She would, even help me, make a skit, for my social media stuff. Or she could, type up stuff, type up like mailing label for my clients, So and then you look at the market rate for things like that, and then you track her number of hours, and then you pay her the market rate. And end of the year, you should, get her on a W-2 and pay her a W-2 income to make it, all legitimate, right? Because that's what a W-2 employee is supposed to get, like a W-2 stuff, right? It's not just a 1099 because she's not a contractor. I hire her, and then we have an employment contract, employer-employee relationship, and then issue her a W-2 and then pay her regularly, right? So some of my clients, they don't want to have to maintain the payroll, so they pay it at end of the year. I don't recommend that. My recommendation is, at least pay it once a month, just like a regular W-2 employee, how they will get compensated, right? So if you follow all the steps, then the reasonable wage is deductible to your business. And depending on your business entity type, if this is a Schedule C, you can, pay your kids without worrying about FICA tax withholding, right? Now, if you are an S Corp owner like myself, then yes, you absolutely have to do it through W-2. You have to do FICA tax withholding for your children. But the benefit is still you get the tax write-off from your business, and your kids have earned income, so you can open up a Roth IRA, when they're 8, and then it's powerful because by the time they go to college, right, the Roth IRA is money basically you can withdraw penalty, like income tax free, and you can use it to fund your kids' education if you want, or if they want to, not go to college and start a business, they can use that as well, right? Move number 8 is the Section 105 plan or QSERA. So if you have a spouse that work in your business, you may want to establish a Section 105 medical reimbursement plan. And this is again, it's assuming if both you and your spouse don't have a group plan because your business is the employer. So you both work for your business, your family business, right? So if you have a spouse that's not working and then she does not have, or she or he does not have a health care plan, you could have your business that's making money reimbursing your spouse, for the medical care insurance, right? You can reimburse the documented 2025 medical expenses, say $9,000, right? That includes your copay, your health premium by December 31st, and then you can deduct that amount 100%. A small employer without group coverage, right, can use QSERA to reimburse up to 6,300 for a single person or 12,800 for a family. The funds must leave the business by end of the year to count. So how does the QSERA work? So let me just give you an example. Let's say if you are LLC, you own an LLC, and then I'm a S Corp, right? So I have employees. And then if I buy group plan for my employee, number one, I don't actually need it. Some of my other employees don't need it because their spouse works and then they are covered under the spouse plan. So maybe just a couple of my employee needs it. So then they're not going to get a very favorable rate, a health plan rate. So it could get very expensive if I were to buy it. And then the coverage will probably be more or less the same as if let's say if they go out and buy it themselves, right? And then what I could do is like, okay, for the few employee who needs it because they don't have coverage elsewhere, I could reimburse them, part of the premium, right? Because the health premium is getting so expensive right now. Let's say a single person, without kids, no dependent, just by themselves, in their 40s or mid 30s, right? You're probably looking at least in Massachusetts, 750 a month, right? So as an employer, you can reimburse them up to 6,350. So not covering the whole thing, but part of it. And then that's tax free to the employee and tax deductible to the employer. But then you need to maintain this Kyocera document, as the employer, because it's actually illegal to reimburse directly reimburse your employee for their health insurance. So you need to set up like proper, plan such as Kyocera to have the reimbursement in place. But you cannot just say, oh, I'm just gonna cover that 100% 750 a month. You cannot do that. That's illegal. The insurance company, if they find out, they will fine you. And I believe it's something outrageously high. It's like $100 a day if you were not following the rules. And again, I think this is a very common issue that, I discuss with all my clients before year end is the healthcare. What is the best way to get healthcare coverage, as a business owner if you don't really have coverage anywhere else, right? Move number nine, stock and gain loss offsetting. So I think this kind of ties back to the crypto, except in this case, it's a little bit different because capital loss and gains net against each other. So a 30,000 loss in one stock can fully offset a 30,000 gain in another position. So if your loss is more than your capital gain, up to 3,000, so this is what you see on the page one of your 1040, 3,000, if you, let's say your capital loss this year is 40,000, but then you have a capital gain of 30,000, right? So you're 10,000 over. Then it doesn't mean that you get to deduct that 10,000. You can deduct up to 3,000 out of that 10,000. The remaining 7,000 gets carried over in the future year to offset future gains. So harvesting your loss deliberately can smooth out your taxable income over several years. Again, it's the same thing, right? Like if you want to bank some stock position and then you do have carryover loss from prior year, for example, it's probably maybe more than 7,000, then you could, cash out up to 7,000 capital gain without having to worry about paying capital gain tax, right? Because you have that carryover loss from prior years. Move 10 is the 199A income threshold management. Now this one's kind of tricky, but I just want to give you guys like a high level overview of how this works. What a 199A deduction, what that is since the 2017 tax law passed, business owners, small business owners especially, who make less than 405K, they get the 20% discount. Now, so that's without doing anything. Like, so if your combined income is less than 405,000, then you are under the phase out limit, then you automatically get the 20,000 deduction on your net profit. So let's say you own a business, right? And then your business net profit this year is $100,000, right? And then let's say you're single by yourself, 100,000 is still under the 197,300 limit, then you get $20,000 deduction automatically without doing anything, just because you own a business, right? You get this discount. The projection will show, if the projection show that you're slightly above the limit, the key here is to, utilize some of the strategy we talk about here, right? Like be it, buying equipment. These are all spending strategies, right? You got to spend to save, or defer your income, or prepay some of your expense. All that is doing is managing your income so that it's well below the threshold. Then you get this 20% deduction, right? So this is what that is, the 199A income management. And then really you need to work with your tax advisor doing this because first of all, you want to make sure you maximize all the deduction. And secondly, because the July Beautiful bill lifted the SALT limit, which is on your Schedule A, And SAL limitation applies to your state income tax, your property tax, your exercise tax, right? It used to be it's capped at $10,000. Now they lift it up to be $40,000. So you need to kind of play around between the 199 deduction and the 40,000 threshold, and then see, which one's gonna give you the most optimal outcome. And then I'm not gonna try to confuse you guys even more by going to the details, but basically what that is if you're a business owner, you could get past that SAL limitation by electing to have your business a separate entity. So if you're Schedule C, this is not going to work. But if you have a separate business entity, you can have the business entity pay the state income tax for you, thereby, getting around that 10,000 or 40,000 limitation. But then when you do that, you also lower, your QBI deduction. So you want to kind of play around with the mix, because you want to make sure that, you are still getting the maximal 20%. So something, you don't want to make it too low, is basically what I'm saying. The real numbers. So let's look at some examples, right? Let's say that, you are a service-based business owner. Let's say that you just own a spa, right? Because this is a real example. Like, you have a Thai massage spa place, right? And then you pay rent regularly to your landlord, and then you had a banner year, right? Like this year, like everybody's just so stressed out, and then so everybody needs a massage. So now it's almost year end, and you report income on cash basis, and then you're sitting there with like $100,000 business net profit, and you're looking at maybe 30,000 in income tax that you need to pay. You want to pay less, obviously. So then what can you do? So you could consider prepaying, your rent to your landlord this year. And by doing this, you probably save about $7,000 in federal income tax, right? And then if you don't have any other employees, let's say it's just you, all you have is 1099 contractors, you could set up a solo 401k. So then that means you could put away, out of that 100K profit, 60,000 to save you 18,000 in tax, right? And then let's say you really want to get a new car because, the commute has, being really bad, and then you just want a, better car to go to work, or, go visit your corporate client, when they ask you to go in and then get massage. You could buy like a used vehicle as long as it meets the gross weight criteria, which is over 6,000 pounds. And then, so you can, carry all the massage equipment with you. Then that's 21,000 that, be it you buy with cash or financing it, you can write that off, right? It's 21,000 that you can write it off. And then you're looking at approximately 46,000, right, in total tax relief. So again, these numbers are based on a typical effective tax rate. I believe in this case, I used about 30% as the effective tax rate. That's a little bit high. Your actual saving depends on your specific tax bracket, right? So then take out your last year's tax return, and then what you take out, take the number, how much tax you pay divided by your taxable income. That is your effective tax rate. And then you can use that rate and then approximate your saving. If you want a personalized plan, it's best that you check with the CPA. And then here are some key business deadlines that you absolutely cannot miss. So December 31st, 2025, if you're thinking of buying any equipment, right, like iPhone, Mac computer, heavy pickup trucks, right? Or expense any of your credit card payments, your software subscription, your rent, your contractors, right? Your QIP, qualified improvement property installation. So if you're thinking of remodeling your office, stock sales, crypto transactions, you gotta have all this done before December 31st, 2025. Solo 401k employer contribution, that's typically due when your tax return gets filed. IRA contribution, same thing. Business entity tax filing, it depends on your entity type. So if you're S Corp, a partnership, that's March 15, 2026. If you're a C Corp, that's April 15, 2026. And then if you're Schedule C, April 15, 2026, right? January 2nd, 2026, delay invoicing client to shift income into the new year, right? So again, this is for client. So if you have a huge order coming in, like maybe don't send out an invoice. And this applies for a cool client as well, right? Just don't bill them. Don't bill them until next year. So you effectively don't need to worry about it until next year, right? So most strategy require your action by December 31st. Your equipment has to be placed in service, not just ordered. If it's at Tesla you're eyeing on the website, that doesn't count, right? It has to be physically here, and then you drove it for at least a mile before midnight to qualify. So here are some common questions. Can I combine multiple strategies that I shared today? Absolutely. I just showed the example where you were stacking like solo 401k with equipment purchase, plus, prepaying some expenses that can multiply your tax saving. The key is really proper documentation for audit purpose and ensure each strategy fits your specific situation. I always tell my client, if it's not in your plan to buy a car, please do not buy a car just to save on tax, right? Like if you're telling me that you've been thinking about buying a new vehicle, but you're sort of putting it off until next year, then absolutely. If you had a banner year, buy it now. Don't wait until next year because it's 100% bonus depreciation this year. Why not? Why not take advantage of it, right? Second question, what if I'm unsure about my income? And again, this is a very common situation for business owners. Either they don't close their book on time or they do their own bookkeeping. And so the record is very messy. And that makes my job like super hard, right? I tell my client, I cannot run the accurate projection if I am dealing with a moving target, right? If every time I meet with them, the income number swing, wildly, then the projection is not going to be accurate. The planning is going to be useless, right? So, but then unfortunately, most business owners either they just don't have enough time to do the proper bookkeeping, or they don't really hire help to do it right. So oftentimes, we have to just use very conservative scenarios, just stay conservative just based on experience. And I hate doing that because there's really no basis except that this is what I see most often across most of my clients, and that's the benchmark that I use. We try to stay conservative, and then but then again, the projection will not be accurate. That it's better to implement some strategy based on the estimated income than not do anything at all, right? So I have clients, that we do some planning based on, a huge net profit number, but then maybe by the time we file the tax return, it turned out to be lost, and which is still be okay, right? Because the strategy that we put in place, it's not waste. It's not gone to waste, right? Like if it's utilized, then it definitely would have saved them a ton of tax. And even if it's not utilized in this year, it will be in future year, right? Because, this client that I have, like we always plan around year end, assuming they will probably make about 500,000 in income. And then when we file the tax, it's always a loss. But this year, the 401k we put in place, the profit sharing that we discussed with your financial advisor finally is being put to use, right? Because the business had a significant growth this year. So nothing's really gone to waste. So it's better to always be proactive and plan throughout the year than not do anything and take any action at all, right? Do these strategies work for LLC and S Corp? Most strategies apply for, all business structures except that section 105, that's only for Schedule C. But some like solo 401k have specific entity requirements, or the section 105, check with your CPA on your particular setup. What about Roth conversion? Again, I don't really come across this quite a lot, but for clients who work in the biotech industry or tech industry, they have high W-2 wage. and then they get a ton of stock options, right? Their income is way beyond the Roth IRA contribution limit. So what I recommend them to do, and this only applies if they don't have a messy IRA account, meaning like, they did not change job, right? Or when they change job, they just, transfer their 401k to the new employer 401k because if you do the backdoor IRA, right? Let's say you want to still max out your Roth IRA contribution when your income is too high, you know, but then you have a, traditional IRA or SEP IRA besides this, the 401k, then the calculation for your Roth, the backdoor Roth IRA, the backdoor IRA gets very messy because it has to be prorated. So, and then again, I don't want to get into the nitty-gritty here, but then just, in a nutshell, if you are thinking about doing Roth conversion, I would do it if it's clean. So like, let's say you only have 401k. That's the only retirement account you have. You don't have a bunch of other pre-tax account, sitting around, and then you want to do this Roth conversion, go ahead. By all means, I think it's a good idea, even when your income is too high. Um, Especially for high tech industries, some of the company offer Roth conversion, like through the company plan. Then yes, I think you should consider doing some of the mega Roth conversions, because the tax rate is only going to get higher, right? And with that, I think that's all the slides that I have. Um, I am going to leave maybe a couple minutes for question, if any. And if not, um, I will definitely send out a PDF checklist called the Last Minute 2025 Tax Saving in the email. This list includes every move that we've discussed today, and then plus, some space for your own notes. So the slides today, plus the checklist, and the recording of this, it's all gonna go out in the email. So please, read it in your own leisure. And if you have any questions, first check with your CPA. And if there's anything that's still not clear, right, feel free to send us a message. We are closed in the next 3 days, but we'll get back to you when we come, resume business next Monday. All right. Thanks, everyone.